In this video, I'm going to show you a US30 sell that made complete sense before it happened, not after. Price runs the highs right at the New York Open. Everyone thinks it's breaking out and then it does exactly what it's supposed to do. This wasn't a lucky sell and it wasn't a guess. I waited for buy side liquidity to get taken. I entered off a key hold price level when price retraced and price delivered a clean 4R straight into a daily imbalance. If you have ever wondered why some moves feel engineered, why price explodes after trapping traders, or how to hold a trade without second guessing every candle, this breakdown will click things into place. Let me walk you through exactly how this unfolded. This US30 sell wasn't luck, it was price doing exactly what it was meant to do. At the New York Open, price runs the highs, takes buy side liquidity, and instead of continuing up, it collapses straight into a daily imbalance for a 1-4 win rate trade. And if you have ever wondered why moves like this feel engineered, this breakdown will make it obvious. So let me set the scene properly before we go any further. This was a US30 trade taken during the New York trading session, specifically around the New York Stock Exchange Open, which for me in the UK is 2:30 p.m. or otherwise 9:30 a.m. New York time, which is important because that's when the market actually shows its hand. Going into the session, I wasn't sitting there trying to predict where price might go. I already had a higher time frame area below that I was interested in, a daily fair value gap. And my job was simple, wait and see how price behaved around the open. I wasn't looking to buy strength and I wasn't rushing into sells either. I was just letting price do what it usually does at this time of day, reach for liquidity first. So in this video, I'm going to break down the full process step by step. We'll look at the higher time frame context that framed the move, what happened at the New York Open, how buy side liquidity was taken, and then how I executed the sell-off of a key hold price level with a defined stop and a clear target into daily imbalance. Nothing here is hindsight. This is simply a recap of how I read the price in real time and how that reading translated into a clean, structured 4R trade. Before we jump into the higher time frame narrative of this trade, I just wanted to show you guys my Discord channel, the live market analysis channel. This is where I actually shared this US30 trade live as it happened from the New York Stock Exchange Open, where price was, and just my thoughts of what I was expecting price to do, a update throughout this move on US30, and then also the final sharing of this trade and just what I was doing. So if you guys would like to become a member, you can click the first link in the description below, and I hope to see you guys soon inside this Discord. Before we even talk about entries or lower time frames, this trade really starts here on the daily chart. Whenever I'm trading something like the US30, I always want to know one thing first: where is price mispriced? And on this day, that answer was very clear, as below the current price, we had a clean daily fair value gap that had not yet been traded into. That tells me price had moved away too aggressively, leaving behind inefficient pricing in the form of a daily fair value gap. From a market mechanics point of view, markets don't like that. When price moves too fast in one direction, it usually needs to come back and rebalance, especially once liquidity is available to fuel that move. Now, this is important. I wasn't assuming price would drop immediately. All the daily chart was telling me was where price is likely to be drawn towards after liquidity has been taken. So when you combine pricing with a unfilled daily imbalance below, you're not predicting a sell, you're simply defining a logical downside objective. So going into the New York session for this day, my bias wasn't price must sell, it was much more neutral than that. My thinking was, If price reaches higher levels, if buy side liquidity is taken, and if we then see signs of rejection, then the daily fair value gap below becomes the natural magnet. That higher time frame narrative is what framed everything that came next. The execution was just the final step, not the starting point. Now, having a higher time frame narrative is one thing, but price still needs the right moment to actually move. And for US30, that moment is usually the New York Open. This is important to understand because outside of this window, US30 can drift, range, or give you false signals. But once the New York session opens, that's when real volume enters the market. That's when institutions are active, orders are being executed, and liquidity actually means something. Around the New York Open, price tends to do one of two things. It either continues strongly in the true direction of the day, or it makes a deliberate move to take liquidity first before reversing, and more often than not, that initial move is designed to trap traders who are late to the party. That's why I wasn't in a rush before the open. I wasn't interested in predicting whether price would go up or down. I was waiting to see which side of the market price would attack first once the session began. Think of the New York Open as the moment price shows intent. Before that, it's just positioning, but once the session starts, price is no longer testing, it's executing. So instead of forcing trades early, my focus was simple. Let the New York Open do its thing, let price reach for liquidity, and then respond after that objective has been completed. That patience is what allowed this trade to unfold cleanly. I wasn't reacting to noise. I was waiting for the moment the market actually had a reason to move. Now, this is the part where everything starts to make sense. As the New York session opens, which for me in the UK is 2:30 p.m. or 9:30 a.m. Eastern Time in New York, price does exactly what it usually does. It pushes higher first, and on the surface, this looks bullish. We're taking out the highs, momentum is picking up, and breakout traders are starting to get interested. I also wanted to quickly note that I am using replay mode here on TradingView, so it's a bit hard to actually show you guys price live in time pushing up higher, as these are the candle closes. But just try to imagine that the New York has just opened with the opening bell, and price is pushing up aggressively, so you automatically assume price is bullish. Anyways, quickly moving on, when you zoom out just a little bit, you can see what's really happening. All of these highs here represent buy side liquidity, resting buy stops, breakout orders, and protective stops from earlier shorts. And price doesn't move through these areas by accident. At the open, price runs straight through those highs. That's the liquidity grab. Orders get filled, stops get triggered, and suddenly there's enough volume in the market for larger players to do business. And here's the key part. After that liquidity is taken, price doesn't continue higher. There's no strong expansion, no follow through. Instead, momentum stalls almost immediately. That's usually your first clue that the upside move wasn't about continuation, it was about accessing liquidity. Once that objective is done, the market has no real reason to keep pushing higher. This is why I never sell before liquidity is taken. Selling into highs without that sweep is just guessing. But once buy side liquidity is cleared and price fails to hold above it, the narrative changes completely. And at that point, the question is no longer will price keep going up? It becomes, now that liquidity is taken, where does price actually want to go next? And with the higher time frame daily fair value gap, which we just spoke about, sitting below, the path of least resistance was starting to open up towards the downside. Now, the sweep itself is only half the story. The real confirmation, the part tells you that this isn't just a breakout, is what price does immediately after it takes that buy side liquidity. Because if that move was genuinely bullish, you'd expect one thing: continuation, big candles, clean follow through, price holding above the highs and using them as support. But watch what happens here instead. Price takes the highs and then it kind of just dies. The candles stop expanding, you start seeing hesitation, wicks appear, the push loses aggression, and most importantly, price struggles to actually accept above the level it just broke. This is what I mean by a shift in intent. The market went from expansion, let's run the highs, to distribution. Okay, we've done the job, now we offload. And this is where most traders get caught, because breakout traders see the highs get taken and they buy late. But they don't realize the market is no longer trying to go up. It already got what it came for. One of the cleanest clues in this, you'll often see price pop above the highs, but it can't hold above them for long. It starts slipping back into range. That's basically the market saying, cool, we've grabbed the orders, now we're done up here. And for me, that's the moment the trade idea becomes real. Not at the sweep, but after the sweep, when price shows it's not interested in staying above those highs, because now the move changes from a maybe breakout into something much more logical. Liquidity taken above and a higher time frame draw sitting below, so price has every reason to rotate back down and rebalance into that daily fair value gap. So at this point, I'm not thinking I'm going to sell right now. I'm thinking, okay, intent has shifted. Now I just need to wait for my entry model to line up. Alright, so at this point we've got the narrative, we've got buy side liquidity taken at the New York Open, we've got a clear shift in intent, and we've also got a higher time frame draw below into that daily fair value gap. Now the only thing left is execution, and this is where most people either overcomplicate it or they rush it. My entry model is intentionally simple. I don't want 10 indicators giving me 10 opinions. I want a small set of rules that keeps me consistent, especially when US30 starts moving fast. So here's the framework I'm using for entries on this setup. Rule number 1. I only look for entries after liquidity is taken and intent shifts. If that part hasn't happened yet, I'm not interested, because then it's just guessing direction. Rule number 2. I use quarter price and hold number levels as my execution map. The reason is simple. US30 respects these levels way more often than people realize. They act like natural magnets and reaction points because a lot of orders cluster around clean numbers, especially on indices. Rule number 3. I want price to come back to a key level and show me that the sell bias is in play. That key level could be a whole number, a quarter level, or a level that aligns with the liquidity sweep structure. But the point is, I want to sell from a place that makes sense, not mid-air. Rule number 4. My stops or my SL is always placed where my idea is clearly invalid. And in this trade, that meant the stop goes above the previous high, because if price breaks above that after sweeping liquidity, then the sell idea is just wrong, no debate. And then rule number 5, the target has to be logical and objective, not emotional. In this case, the higher time frame draw was the daily fair value gap, and the exact profit objective was aligned with a major hold price level sitting near that daily imbalance. So in this case, it was the price level of $49,000. I know zooming out here on the 5-minute chart, that seems very far away, but if I zoom out furthermore, from our higher time frame analysis that we spoke about earlier, here's your daily fair value gap. So very simply, I just picked the hold number above that daily fair value gap, which was simply 49,000, which was also in line with this supply and demand area in price. So it seemed like a logical level to place as our profit level, or otherwise known as TP. So notice what this model does. It keeps everything grounded. We have a reason for direction, we have a reason for timing, we have a reason for entry location, we have a reason for the stop, and we have a reason for the target. That's what makes it feel calm, because you're not reacting to every candle, you're just executing a plan. Now, let me show you the exact level I used for the entry, because this is where the quarter level becomes the trigger that turns the whole idea into an actual trade. Alright, now let's get very specific, because this is where the idea turns into an actual trade. Up until this point, nothing here is an entry. We've seen buy side liquidity taken at the New York Open. We've seen price fell to hold above the highs. And we have established that the higher time frame draw is sitting below into a daily fair value gap. So now I'm not asking will price go down. I'm simply asking where is the best place to sell if it does. This is where quarter price and hold number levels come in. On US30, these levels act like natural decision points, not because they're magical, but because a lot of orders naturally cluster around clean, round numbers. After the liquidity sweep, price starts to roll over and give a pullback, and instead of chasing that move, I let price come back into a key hold price level that lines up perfectly with the post-sweep structure. So as soon as price retraced back up into this whole price level of 49,500, this was my entry point, and I put my stop loss above the previous high, again at the quarter price level of 49,625. So after that level became my execution zone. The logic is simple. If sellers are generally in control after the sweep, then price should not accept above this level. This is where you expect resistance, hesitation, or rejection, not clean continuation higher. So as price trades back into that whole level, I'm watching very closely. I'm not looking for anything fancy. I'm just asking one question. Is price being accepted above this level, or is it struggling to stay there? And in this case, price taps the level, stalls, and starts to rotate back down. That tells me sellers are defending this area, which is exactly what I want to see. That's my entry. I sell directly off the whole quarter price level after liquidity has been taken, after intent has shifted, and at a location where my risk is clearly defined. This is the part most traders like to skip. They see price start dropping and they sell late in the middle of the move. But by using these key levels, I'm able to enter from a position of control, not emotion. Once I'm in, there's no second guessing. I know exactly where I'm wrong. I know exactly where price is likely drawn towards, and I'm no longer reacting to every candle. And that's what turns this from a random sell into a structured trade. The entry isn't about speed, it's about location. Now let me show you where the stop goes, because that's what actually protects this trade and keeps the risk tight. Now let's talk about the part that actually makes this a trade and not a gamble, the stop loss, because the entry can be perfect, the bias can be perfect, but if your stop is random, your whole strategy is random. For this setup, my stop was simple, above the previous high, not above some random number, not 20 points because it feels safe, above the high that the market just created when it swept buy side liquidity. Here's the logic. The whole narrative of this trade is price runs the highs at New York Open, grabs liquidity, fails to continue, and then rotates lower towards the daily imbalance. So if price comes back up and starts trading above that previous high again, and especially if it holds above it, then what does that tell us? It tells us the sweep wasn't a sweep anymore. It tells us sellers didn't defend. It tells us the market isn't accepting higher prices, which means the downside idea is no longer valid. In other words, my stop loss is placed exactly where my idea is wrong. That's the only stop placement that actually makes sense. Anything else is just you trying to avoid taking a loss. And this is the part a lot of traders get backwards. They'll place stops based on comfort, not invalidation. So they either put it too tight and get clipped, or they put it miles away and destroy their risk to reward. Here, the stop is clean because it's structural. The level I sold from is a key whole price level, and the high above is the point the market already showed its hand with. If it reclaims that and holds it, I'm out. no emotion, no let's see, and definitely not hoping. And that's what gives me the confidence to hold for a 4R trade, because once your risk is placed logically, you're not babysitting the trade, you're not panicking on every pullback, you're not moving your stop to break even after just 2 candles, you're simply letting price do what it's supposed to do. And if it doesn't, you take the loss like a professional and you move on. So stops above the previous high, idea invalidated, risk fixed, that's the foundation. Next, I'll show you the target logic, because the reason this trade could deliver 4R wasn't because I was greedy, it's because the target was based on a higher time frame draw and a clean hold price level. Alright, now let's talk about the target. By the way, this is the 1 hour chart which you guys are now seeing here, because this is the part that decides whether a trade becomes a quick scalp or a clean 3R, 4R, even 5R type of move. Most traders pick targets emotionally. They'll take profits because they feel like it's gone far enough, or because they see one green candle against them and panic. But on this trade, the target was decided before the entry, and it was decided for one reason: where price was most likely to be drawn to next. Remember the higher time frame context. We had a daily fair value gap below price that hadn't been rebalanced yet, which is right over here, our daily fair value gap area. And so my primary objective wasn't make money, it was simple. If buy side liquidity has been taken, in this case it had, and intent had shifted, the next logical draw is towards that daily imbalance. Now here's where I tighten it up with execution. I didn't just target the fair value gap in a vague way. I aligned the target with a key hold price level near that daily imbalance, and in this case that was 49,000, a flat key hold price level, 49,000 above or near enough to that daily fair value gap. And that's important because hold levels act like magnets and reaction points on US30. Again, not because they're magic, but because they're clean numbers where a lot of orders naturally sit. So instead of saying I'll just take profit somewhere in the gap, I'm saying I'm targeting a very specific objective level where price is likely to react. That does two things for me. It makes the target non-negotiable, no guessing. It makes the trade scalable because now the R multiple becomes a function of structure, not emotion. And once I mapped that target, the 4R made sense on paper. It wasn't me hoping for a home run. It was simply the distance between a clean execution level up here and a higher time frame draw down there. Another key point, I wasn't trying to squeeze every last tick out of the move. I chose the whole level near the daily fair value gap because that's where I expect a reaction. If price bounces there, fair enough, the objective is complete. So the target selection is basically daily fair value gap as the draw and the whole level as the exact price objective. That's what allowed me to hold this trade with confidence, because when your target is logical, you don't feel like you're being greedy, you feel like you're simply letting price deliver to the next obvious destination. Now next, I'll break down trade management, because the interesting part isn't just where I entered and targeted, it's how I stayed disciplined enough to let it actually hit. Now, this is the part that most traders don't like hearing because it sounds almost too simple. But the way I managed this trade is actually the reason it was able to hit 4R without me sabotaging it. I didn't micromanage it. Once I was in, I wasn't sat there trying to be a hero, moving stops every 2 minutes, taking partials out of fear, or closing the trade the moment it pulls back. I already had 3 things defined before I clicked that sell button: my entry, my invalidation, and my objective. So the management became very basic. I just let price work. Here's why this matters. US30 is known to be fairly aggressive, it moves fast, and if you're watching every candle, Your emotions will convince you to interfere. A small pullback feels like the whole move is reversing. A small pause feels like you're about to lose everything. And that's how people turn good trades into break-even trades and break-even trades into losses. So my mindset is, if I've entered from the correct location with the stop loss in the correct place and I'm targeting a higher time frame draw, then a pullback is normal, because I don't need to protect profit 5 minutes into a trade that's designed to travel to a daily level. Now, I'm not saying you should never manage trades, but for this type of setup, liquidity taken, intent shift, entry off a key level, target into higher time frame imbalance, the best management is often no management, because the structure is already doing the work for you. So what did I actually do while in the trade? I left the stop where it was, above the previous high, and only moved the SL when a new invalidation area was present in price. I left the target where it was, the whole level inside the daily fair value gap, and I simply watched for one thing. If price starts reclaiming the level that invalidates the idea, I'm out. If not, I let it run. That's it. And this is important. This is how you hold for a 4R. Not because you're fearless, but because you're not making decisions mid-trade. You've already made them when you were calm. So when price started moving in my direction, I didn't take the win early. I let it do what it was meant to do, rotate down towards the daily draw, and I stayed out of the way. Next, I'll show you the result clearly on the chart and break down the R multiple so you can see how this played out from entry to target without any hindsight fluff. Alright, now let's look at how this actually played out. Cleanly, start to finish. Here's the entry at the top. Here's the stop loss above the previous high. And here's the target sitting at the whole key price level of 49,000, just above the daily fair value gap. Nothing has moved, nothing has been adjusted. This is exactly how the trade was planned before it was taken. Once price leaves the entry area, you can see it starts doing what we expected. It had pauses, small pullbacks, and moments where price consolidates. And all of that is normal behavior when the market is repricing towards a higher time frame objective. This is an important point to understand. Clean trades don't always look clean candle by candle, they look clean in structure. As price continues lower, you can see it respecting levels, failing to reclaim the execution zone, and gradually expanding towards the downside. At no point does it give a valid reason to interfere with the trade. The invalidation level is never threatened, so the original idea remains intact the entire way down, and eventually price trades directly into our target, the whole level aligned with the daily fair value gap. That's the objective completed. From entry to target, this trade delivered a 4R. Now, not because I was trying to hit a specific R multiple, and not because I forced anything, but simply because the distance between a logical execution point and a higher time frame draw naturally allowed for that reward. This is why I always say R multiples are simply a byproduct of structure, not something you chase. When you enter from the right location and target the right area, the reward takes care of itself. And notice something important here. This wasn't a massive chaotic move. It wasn't news-driven chaos or a random spike. It was price doing exactly what the narrative suggested it would do. Take liquidity, shift intent, and rebalance into inefficiency. So when you look at the result on the chart, the 4R isn't even the impressive part. The impressive part is that every piece of the trade, entry, stop, and target, they were respected without any need for intervention. So in the next section of this video, I'll break down the key lessons from this trade, not just what went right, but what most traders would have done differently here and why that usually costs them trades like this. Now, the most important part of any trade recap isn't the entry or the profit, It's what you can actually take from it and apply it to your own trading, because this US30 sell wasn't special. The conditions that created it show up again and again, and if you know what to look for. So let me break down the key lessons from this trade. And I want you to think about these in terms of process, not just this one example. The first lesson: liquidity comes before direction. A lot of traders, they try to predict where price is going next. This trade worked because I didn't do that. I waited for price to show me which side of the market it wanted to attack first. Once buy side liquidity was taken at the New York Open, the upside objective was completed, and only then did the downside become valid. If you remember nothing else from this video, remember this: direction without liquidity is just an opinion. Second lesson: timing matters as much as levels. The same highs could have been taken during Asia or London, but meant very little. What gave this move weight was when it happened, right as New York opened and when real volume enters the market. Good levels at the wrong time often fail. Average levels at the right time often work. Third lesson: execution is about location, not speed. I didn't sell the moment price started dropping. I waited for price to come back to a key whole quarter level where my risk was tight and my invalidation was clear. Most traders lose because they chase moves. Using clean execution levels forces patience and keeps you out of emotional entries. Fourth lesson: your stop should prove you wrong, not make you uncomfortable. Placing the stop above the previous high, that meant that my trade either worked cleanly or I was wrong quickly. There was no gray area. When your stop is based on invalidation, holding trades become easier because you're not constantly wondering if you're about to get stopped out for no reason. And fifth lesson: targets should come from higher time frame draws, not fear of greed. The reason this trade was able to deliver a 4R is not because I was trying to hit a 4R, it's because the daily fair value gap below was the next logical destination after liquidity was taken. When your target is logical, you don't feel the need to interfere. You're not being greedy, you're simply letting price rebalance. And if you put all of these together, you will notice something important. This trade, it wasn't about being aggressive, it was about being patient, reactive, and precise. In the next part, I'll talk about the most common mistakes traders would have made in this exact situation, because understanding what not to do here is just as valuable as knowing what worked. Now, this is where things get really interesting, because this exact move traps a lot of traders, and not because they're bad at trading, but because they're reacting at the wrong moments. So let's walk through the most common mistakes traders would have made on this setup, and I want you to be honest with yourself as you watch this, because most people see themselves in at least one of these. The first mistake: buying the breakout at the New York Open. Price takes the highs, momentum picks up, and it looks like a clean continuation, so traders buy the breakout right into buy side liquidity being cleared. The problem isn't that buying breakouts is always wrong. The problem is buying them after liquidity has already been taken when the upside objective is complete. That's how you end up buying the high and then wondering why price immediately reverses on you. The second mistake: selling too early, before the sweep. On the other side, some traders try to sell the highs before liquidity is taken because they feel like price is overextended. That's just anticipation. Without the sweep, price still has reason to go higher, and that usually means your early sell either gets stopped out or puts you under unnecessary stress before the real move even begins. The third mistake: chasing the move once price starts dropping. After the sweep and the initial push down, traders panic and they're going to miss the move. So they'll sell mid-leg, far away from any key level, with a stop that makes no structural sense. Even if price continues lower, these trades are hard to hold because the risk is undefined and the stop is emotional. The fourth mistake: moving the stops to break even too early. As soon as price goes a bit into their favor, traders, they like to rush to protect themselves. They'll move the stops to break even and price pulls back normally and they get taken out of a trade that later runs exactly where they originally expected it to run to. This usually comes from not trusting the original plan or from entering in the wrong location to begin with. The fifth mistake, taking profits randomly out of fear. Price moves a little or it stalls for a moment and traders take profit because they don't want to give anything back. But in doing that, they turn what could have been a structured 3R or 4R trade into a small win that barely covers losses from earlier mistakes. And when you step back and look at it, all these mistakes have one thing in common. They're reactions to candles, not response to structure. This trade worked because nothing was rushed, liquidity was allowed to be taken, intent was allowed to shift, the entry was taken from a logical level, and the trade was left alone to do what it was meant to do. In the final part, I'll leave you with one simple idea to remember, because if you understand this one concept, trades like this stop feeling random and start feeling repeatable. If there's one thing I want you to take away from this trade, it's this. The market didn't change its mind here, it simply finished one objective and moved on to the next. Price went higher first because it needed liquidity. Once that job was done, it didn't need to stay there anymore, and instead of fighting that or trying to predict it, I just waited for price to show me when that shift had happened. That's really what trading is at its core. Not predicting where price will go next, not being early, and definitely not reacting emotionally to every candle. It's about understanding what price is trying to accomplish at different moments, and then simply positioning yourself after that objective is complete. This US30 sell wasn't special because it made 4R, it was special because it followed a repeatable process where liquidity was taken, intent had shifted, and execution was from a key level and a higher time frame draw guiding that move. Once you start seeing the market through that lens, trades like this stop feeling stressful. You're no longer chasing moves or forcing entries, you're simply responding to structure. And when you trade that way, results become a byproduct of patience and clarity, not speed or aggression. If this breakdown helps you see the market a little more clearly, let me know. Drop a comment and tell me what part of the trade stood out to you the most, the liquidity sweep, the entry off the whole level, or the way the trade was managed. And if you want more trade recaps like this one, just clean explanation of how price actually moves, feel free to subscribe so you don't miss the next one. That's it, and appreciate you guys watching. I'll see you in the next one.